Todd.
Here's Todd.
Hi, guys.
Hi, everyone. Thank you very much for your interest in the topic. I believe everyone here is familiar with the concept of tokenization, but just setting the stage for our conversation, tokenization is the process of creation of a token on blockchain, a token that represents an asset. Tokens can be representations of tangible assets such as real estate, commodities such as gold, financial assets, fiat money, equities, bonds, or non-tangible assets. I'm Tatiana. I'm Director for Central Banks and Public Policy at the World Gold Council. The World Gold Council is the gold market development organization, and our main focus is to digitalize the gold market. Of course, tokenization of gold is one of the key aspects to that. Today, we'll delve into the specifics of asset tokenization, its potential impact on the market, and the potential for mass adoption. I'm joined by three experts in the field. Todd Lippiatt, founder and CEO of FutureFin. Gaetan Thabot, Head of Protocol and Foundation Partnerships, Blockdaemon. And Benjamin Dean, Director of Digital Assets Europe at WisdomTree. If you wouldn't mind introducing yourself, that'd be great.
Who do you want us to start with?
Please do.
OK, I'll go first then. So Gaetan here from Blockdaemon. So Blockdaemon is a $3.5 billion valued company. We talk to a lot of institutions, and I think it's primarily the reason why we're on this panel is a big topic has been tokenization in our conversation. We offer three types of services: nodes, read and write types of access to blockchain data, staking, which we've been pretty famous for, at least within the realm of crypto, and now, as of a year and a half ago, self-custody solutions for institutions, which obviously is a big topic in relation to tokenization.
Great.
I'll stop here.
Ben?
Well, it's nice to be here. I'm Benjamin Dean, Director of Strategy in the Digital Assets team at WisdomTree. WisdomTree is a traditional asset manager, about $100 billion in assets under management at present in the United States and Europe. Our digital asset team is a bit over 30 people now. It's a growing segment of the business. There's a whole story about how and why we've entered that space, and we've been active in the last few years, which I can cover throughout the course of our session today. But we do have a series of SEC-approved tokenized funds in the United States. We have tokenized gold, tokenized Bitcoins and Ether for that matter. So I can go into some more detail on that, but we are quite active in the space at present.
Great, thank you. Todd, and if you could please say a few words about yourself. It's great that you can be here with us online, despite the difficulties.
Yes, thank you. Apologies for not being there. The airlines had other plans for me, but happy to join. Todd Lippiatt, CEO, founder of FutureFin. I do advisory and consulting. I wrote my white paper, is just celebrated its 5-year anniversary. Two-token waterfall, which was one of the early white papers on the tokenized space, and I followed and been involved with it ever since.
Thanks. Thank you. So maybe to start, the concept of tokenization emerged a few years ago, but it didn't pick up then. And it's only over the last 12 months that we've seen an increased interest in tokenized assets. Gaetan, why do you think that is? Is it a new trend? What are the driving forces behind this increased interest now?
Yeah, so no, I mean, I think the concept of tokenization is not new, right? The fact that we represent value on chain is nothing new. It started when blockchain started, essentially. Value was represented there. A new concept now maybe is representing real-world assets, RWAs, on-chain, and at a scale that is sort of meaningful. Because obviously, USDC, USDT, any kind of USD representations were just that, right? The fact that a real-world asset was represented on-chain, and the market was maybe 100 billion for stablecoins, but now we're looking at other markets like money market funds and equities and all the real estate, commodities, all the other asset classes that can represent really big markets and TAM, right? Total addressable markets. And so I think that is a new component as to why tokenization become hot and is exciting. And another one is the fact that it's kind of too big to be ignored. And what I mean by that is you can look at the list of traditional financial institutions who are doing POCs or getting ready to production when it comes to tokenization. It's just massive. And so as an incumbent, you don't want to miss the boat, and therefore, and I can say that with a straight face because Blockdaemon talks to a lot of different institutions, and publicly or non-privately, we see and hear from these traditional institutions that they're deeply into tokenization of real-world assets, which I think is a sort of a new trend. 2 years ago, they were starting with POCs. Now they're getting ready to production grade level. And that is an exciting unlocker for the space and makes us very bullish.
Ben, would you like to add anything to that? Have you seen this increased interest among your clients, in particular institutional investors? Because I guess that would be one of the conditions behind the mass adoption.
Yeah, for sure. I mean, before the session, Gaetan and I were kind of just sharing thoughts. And I mean, I agree, this is not new. Anyone who's followed this technology since the outset saw very quickly tokenized US dollars or stable coins being used. I just think it took a lot of people a while to actually understand how this technology works, right? I remember people arguing about Bitcoin, what backs it, and the Ethereum network, you know, what are these DeFi tokens? You know, what do they mean? Are they voting rights? Are they equity? Eventually, it became fairly obvious that you can put a whole bunch of US dollars in a bank account and issue tokens against it, stable coins. You can put gold in a vault and issue tokens against it. You could do any kind of asset with the custodian set up and you're just using different infrastructure in order to distribute it. You know what that looks a whole lot like? Exchange-traded funds and products, which is WisdomTree's kind of wheelhouse, is what we've been doing for 15 years. It's just instead of listing the shares on an exchange, we're issuing tokens against an asset that's custodied, it's regulated, and we're running it over mobile apps and blockchain networks. So it's just taken people a while to catch up with this stuff, but now the secret's out. And that's part of the reason we see the buzzword tokenization now coming out of just about every single large asset management company out there at present.
Sure. Yeah. You mentioned the issue of technology as well. Todd, how does the process of tokenization of an asset look like in practice in terms of asset sourcing, issuance, token issuance, custody, trading, redemption, regulatory compliance? If you could please say a few words about that based on your experience.
Sure. So a couple of different things to make a distinction here. So first is, you know, there's tokenized. We focus, there's bespoke product and then there's sort of commoditized product. So there's, you know, stock, bond, things that are issued en masse that are ultimately fungible. And then there's specific bespoke product. We focus initially on the real estate market. Each individual transaction is, you know, definably bespoke. And how do you actually have an issuance into the product? And so issuing tokens isn't actually that hard. We did 5 proof of concepts back in 2018 that were all regulatory compliant through a broker-dealer. Private placement issuance, so forth. The issue really becomes, what's the advantage? It costs more to issue on tokens than it does in sort of the analog markets right now. So, we have the problem of, or what we face, and what I think is still some of the problem with some of the bespoke issuance platforms is you have adversely selected product. And so that was part of it. And then the other part on the more public side or the more commoditized product is, these, until a standardized framework is adopted, it's a down in liquidity trade. There aren't that many counterparties, you're running on bespoke protocols. And so you run into the issuances, you're issuing into a sandbox of which only a few people can actually participate. So, there's some issues that need to be resolved within the industry. But I mean, the progress has been amazing thus far. The redemption side is actually fairly easy because you're running through, at least in the US, you're running through regulated, compliant entities. You're never going to be truly decentralized. And that was a lot of the struggle, at least initially, was you had DeFi protocols that went the DeFi way, you had securities backed, or securities trained people that were like, well, we have to be compliant, and those were functionally adverse to one another. So, again, the issuance is not that hard. It's sort of what's the advantage gained at this point in time, and what does adoption look like as you get more people into one or more sandboxes that actually where liquidity can be provided.
Mm-hmm. So there are challenges. So what are the benefits for asset owners then?
So asset owners, ultimately, all of this comes down to cost, right? Can I get a better yield? Can I, is there better liquidity that will result in better yield? Is there, reduced issuance costs? Streamlining these is going to be the benefit. The real benefit to tokenization, as I wrote a long time ago, is you actually get asset transparency where it really is very difficult to achieve in sort of the analog world, in so much as understanding a market, understanding all the related third parties, consolidating these into one form where you can, actually value the security from information that is on-chain and readily available to everyone. There's so many private information, providers related to, and I came from the mortgage-backed industry, and retail couldn't possibly even now, pick a tranche in, mortgage-backed structured product, and value it appropriately without paying fairly a lot of money for third-party analytics in order to do so. So there is some leveling of the playing field that can happen, but getting a standard tokenized issuance framework so that everybody can operate off of the same playing field still hasn't been achieved.
Maybe if I can add to the cost piece, because I think definitely it's a good point, but there's a lot of other benefits that I think we talk about when it comes to peer-to-peer distributed systems in general, around transparency and ultimately the composability of the data, right? Once you've tokenized an asset, what can you do with it? How can you leverage it? And it's always interesting to look at the various derivatives that exist in blockchains. If you look at trading volumes, there's probably 75–80% of tradings that are actually tradings of derivatives asset versus spot assets. So instead of an Ethereum, it's a wrapped Ethereum. A Bitcoin, it's a wrapped Bitcoins, and all the futures and all these kinds of financial trading instruments that exist. And I think the composability aspect enabled by blockchain or peer-to-peer systems in general is a very interesting one in terms of the benefits that once you've tokenized an asset, what can you do with it? How can you use it, transform it, exchange it in a much more, to your point, Todd, frictionless way, particularly on the cost side, but also on the speed of transformation, on the auditability from an auditability perspective, and all the other components that transparency and immutability, which are the properties of blockchains, offer. So I think these are, fundamentals also, benefits that we see in the space.
Certainly, I also agree that in terms of efficiency gains, tokenization brings so much. And Ben, among your clients, have you noticed any benefits on the side of new markets that the tokenization can bring in terms of, you have fractional ownership, cross-border transactions, which opens the international markets? Have you seen that among your clients?
For the moment, it's such early days. I have certain hypotheses around those topics and those potential benefits. It's a funny thing that happens when you've got new infrastructure. It's only as useful as the number of people who are using it. And because there's so few players out there at the moment, we haven't really hit that critical mass that would allow me to point out and prove those potential benefits.
What is the critical mass?
Some of the ones I could foresee is the T0 settlement. T0 settlement, regardless of where you are in the world, that's substantially better than the current infrastructure. The flow-on effects of less intermediaries should flow into lower costs, not just for us as the provider, but they should be passed on to the end user. No more charging 5% for cross-border transmissions. What should happen is you should start seeing global liquidity being tapped for certain assets where today we have fragmented infrastructure. This comes back to which assets are regulated in what ways, and are you actually able to have global markets for certain assets? An example of one where you have a lot of trouble is what's called a 40 Act mutual fund in the United States, which is a security. Contrast that with gold or Bitcoin, which are both commodities, and as a consequence, can trade more readily across borders. So there's just 3 areas on top of the transparency piece. There is an automation piece, but that just flows back again into lower costs of
So
managing.
in terms of the impact on the market, such as the market being more accessible, more inclusive, more transparent, that the pricing would be more accurate, which of these aspects do you feel would be most important, and who would benefit most from the tokenization itself? Todd, would you like to give us your perspective on this?
Sure. So, I mean, the retail and the institutions are going to be the ultimate beneficiaries of this. As you remove, and I think there's a fork in the road, as it were, when it comes to tokenized products and the protocols that are actually trying to achieve, a streamlined tokenization process. It's either we are going to bespokely or independently solve each one of the individual layers that currently exist within trading and settlement, clearing, custody, so forth, in one fell swoop in one protocol, or there's going to be a bunch of different companies that are going to effectively recreate the current process, but on-chain. And so, I think the real benefit of tokenization is actually replacing the entire system. To do that is a monumental task of adoption. I'm not even certain if you can predict if that could happen. I think you're going to start seeing individual processes replaced by tokenization. But if you do achieve this sort of full-scale, single system that can actually go through all of the different layers that currently exist, there is ultimately a ton of efficiency because you're removing the intermediaries. All of them cost money to either issuer or retail. And so as we go through the process in doing this, you're seeing some adoption, but, on certain fronts, but ultimately, the settlement layer is going to prevent a lot of participants unless, uniformly, like BIS or somebody sort of says, this is the chain where tokenized assets will settle. We're not going to have to bridge anything. We're not going to have regulatory compliance across multiple chains in order to actually settle. These are the type of issues that ultimately need to be resolved for the efficiency to actually come through.
Thank you. Gaetan, what do you think in terms of the impact on the market?
Yeah, kind of how I alluded to it, I think it's too big to be ignored now, and that is reflected by the size of the market. I mean, if you look at the various reports that are published by consulting firms, research firms, VCs, yeah, the addressable markets when it comes to equities, when it comes to stocks, when it comes to much less accessible, I would say, class of assets like real estate or even commodities in some fashion, is massive. So when you superpose the size of the market and the benefit that the technology at its core can provide, sounds like a good recipe to me, right? And so I think that's part of why a lot of institutions started going into POCs, but now moving into how do we scale that? How do we move that to production levels? And that's where the entire ecosystem that builds on blockchain and around blockchain is important. That's where we feel, as an infrastructure provider, we usually say that we're the third largest security provider for blockchain, simply because we run so many validator nodes across different blockchains. As an infrastructure provider, we feel like we have a role to play, to professionalize, to standardize how tokenization happens and make it as safe and compliant as possible, depending on where you are in the world, obviously. Following these regulations, following these standards. So yeah, I mean, it's a long way of saying I think the impact is massive.
So in terms of technological barriers, when we talk about mass adoption, are there any technological barriers that you see that could potentially postpone the mass adoption of tokenization?
Is that for
yes,
me?
that's for you and for Ben.
Do you want to start?
Yeah, look, we have a thesis, which is that once we're at this mass adoption moment, the people who are using the technology won't know or care that it's running on-chain. The same thing happened with end-to-end encryption. You all have it in your WhatsApp. You're all using it all the time, but none of you know about the public-private key pairs that are running on the back end, and you don't have to know, right? That's why everyone's using it. In this instance, if we abstract away all the complexity, managing the private keys, keeping them safe, we get the user interfaces to something that people are used to using. At the end of the day, they just won't see any of the back-end machinery and won't care. But what we do think that they'll have is, because this technology is digitally native, they'll get access to products they couldn't get before or more manual systems. Let's give you one quick anecdote, I hope that illustrates it. I was in Austin the other month getting a cab, so it's a cab driver story. And this guy asked why I'm in town. I said, I'm here for a crypto event. Oh yeah, crypto. I lost a lot of money on Dogecoin. And I was like, oh, you shouldn't be buying Dogecoin, man. He's like, so what should I be buying then? I said, look, US T-bills are paying 5.5% right now. It's risk-free. He goes, what's a T-bill? I say, oh, well, you lend money to the US government and then they pay you interest on it. I said, how much does your bank give you? He's like, I don't know, it's definitely less than 1%. He's like, all right, these T-bills, can you write that down and can I buy it on Coinbase? So how can someone just go and buy T-bills? If anyone's tried to use the setup through the Fed, it's impossible to use. This guy doesn't have a Charles Schwab account. He does have a cell phone and Coinbase, and now there's tokenized wisdom tree T-bills that run on the same infrastructure. That's just like a little anecdote to show that there's got to be some segment of the market that just cannot access these products because the current providers can't do it in a way that's affordable, but we can potentially use this infrastructure, the blockchain infrastructure, to get those products to people who otherwise just really can't get them. So,
Todd, what do you think? How ready are blockchain providers for mass adoption of tokenization?
Well, just going off the last analogy, just because I spent a fair amount of time looking at actually the treasury market, is You can currently buy T-bill-backed products. It's really an ETF on some of the DeFi protocol, one particular DeFi protocol that I won't mention. But the issue is, what are they doing on the back end of that? And I would argue that, I mean, if the guy can set up a Coinbase account, he can set up a Schwab account just as easily at this point in time. It's the exact same KYC process. So if he happens to be on Coinbase, that's fine. And so there are DeFi protocols that actually allow you to buy US Treasuries. The problem is, at this point in time, and this isn't, I mean, it isn't that hard to figure out. It costs more. I mean, the real yield is roughly 37 basis points as of last week. Differential between the cost of the actual ETF that the underlying DeFi protocol is purchasing versus the cost of just buying it direct in, like, off of the New York Stock Exchange. And that's the cost of putting in tokenized form. Can more people access it? Sure. But there's a cost to it right now that is negative as far as tokenization goes. If we can streamline those costs so that it, you know, maybe there's a 5 basis point give up, that's fine. But it's much bigger than that right now, and so perhaps adoption will sort of clean that up a bit. But yeah, it does democratize access to the product to a certain extent. But if you're buying securities, you're still going through the same regulatory schema. I mean, you still got to get KYC. You know, you're out of the DeFi realm significantly at that point in time. So, I mean, it's there. It does exist right now, but it is still prohibitively expensive, especially when you start talking about institutional adoption. This isn't a retail, like, tokenization is not ultimately going to be a retail product. If institutions don't adopt it, it doesn't get adopted, right? You need to get TradFi crossover into these products. And so, you know, there has to be more efficiency or a bigger problem to solve so that the efficiency can actually show itself through. I happen to think that more bespoke product, not the more liquid product, is where the emphasis should be placed right now. And I see adoption more through, like, new asset classes, because there isn't this entrenched, you know, sort of schema in which all the service providers already exist. If you can kind of create a new way of settling a new product, that may be the bigger proof of concept that may actually take off.
Okay. In terms of institutional adoption, is the lack of trust an issue? Are institutional investors hesitant to invest in tokenized assets?
Sorry, are they what?
Is the lack of trust an issue for institutional investors to invest in tokenized assets? What's the reason why they are hesitant?
I mean, I think the elephant in the room is definitely regulatory clarity. That being said, some jurisdictions, Singapore, with the Monetary Authority of Singapore, have provided a framework around how to handle digital assets and what that means in terms of payments in and out of the country, for example. I know there is MiCA or MiCA, depending on how you pronounce it in Europe. In the US, it's a bit lagging, definitely. I'm based out of the US, and I work with our US team. It's definitely the market that has the most uncertainty when it comes to regulation. So I think there is this element of trust that token holders, VCs, hedge funds, asset managers, custodians have to face, depending on where they are in the world. As an infrastructure provider, I think there's also an element that I'm very biased towards, which is the professionalization of infrastructure in the blockchain space. There is not, you know, decades of research behind it necessarily. And so that's something that to me is a standard that we are, the team, that the 200 people plus that we have at Blockdaemon are working on. It's definitely how do we make it not only efficient and user-friendly, but also secure, compliant, in order for ultimately institutions to be able to trust it and feel like they can explain it in plain language to their overseeing authorities, regulators, and ultimately serve their end users. So I feel this element of trust is also an important one, is how do we professionalize our services in the space? So yeah, it's been kind of a core focus, at least for us.
I totally agree that the lack of regulatory clarity and regulatory uncertainty is absolutely crucial here, because on the one hand, you have investors that would benefit from a safety net. So sovereign wealth funds, they would never invest in something that's not regulated. And on the other hand, you have token issuers, service providers that also need this clarity. Ben, if you were to give one piece of advice to a regulator in terms of optimal framework for tokenized assets, what would it be?
Well, I'm not sure that I would go and start handing out advice quite so directly. Consistency in rules across jurisdictions is helpful in some cases, and we're seeing that occur. So that's probably all I'd say in response to that particular question.
Mm-hmm. Todd, do you have any thoughts on that?
Advice to regulators? Yeah, start approving protocols. I mean, all the protocol-based tokens are, none of them have been declared, except for ETH, I guess, has been declared a commodity, although I think the SEC wants to revisit that. But, start making declarations. This protocol is a security. This is not a security. It all goes down to the settlement layer. So start from the bottom and work your way up.
Yeah, I think the advice is be curious. Learn about this technology. It's new. There's a lot of language around it that needs to be understood. It's also a new way of looking at different asset classes. Just be curious, learn about it, exchange, try to understand. I don't know who I talked to earlier that was saying, well, yeah, obviously old frameworks don't apply to necessarily to tokenization and tokenized assets, at least all the classes of tokenized assets. And that means from a regulator standpoint, it means, well, you need to invent something new, you need to adapt what exists already, you might keep the same principle, but just apply it differently. So I feel that everybody here, by the way, has a role to play in helping educate, helping standardize how all these blockchain ecosystems interact.
Absolutely. And if you were to look at various jurisdictions as a service provider, token issuer, investor, which jurisdictions, from the regulatory perspective, would be most friendly at the moment? Ben, what do you think?
From our discussions, we've found Luxembourg to be relatively... Luxembourg. Mm-hmm. But that's not to say we have any operations or set up in Luxembourg. But when we go out and chat with people in the space, particularly in Europe, they often gravitate there. But it's a fast-changing landscape, right? So the answer would be totally different in 6 months, I have the feeling, as other jurisdictions like the Singapores, the Switzerlands of the world, and the UAE continue to make changes. But so that's, maybe the most succinct answer I can give you on what's a pretty big topic.
Mm-hmm. Todd, what do you think? You've worked in Germany for a while, from what I know.
Yeah, but even in Germany, they were issuing out of Luxembourg. So I agree with the last comment. Definitely not the U.S., and it'll be a little while. I think with MiCA, Europe's going to be probably at the forefront. Which specific jurisdiction depends on adoption, but Luxembourg has been, the precedent that has been set. Although I do agree that Singapore has a good challenge. It was a good challenger to the champion at this point. So we'll see. Yeah, I agree. 6 months, a year from now, there will definitely be a different answer.
So Luxembourg, Singapore, not the US, Europe.
The British Virgin Islands, if you want to, or Salvador.
Great. We still have 4 minutes. And I was wondering whether there are any questions. Oh, I see one question there.
Hi, I kind of have a hypothetical question. I'm thinking if a Bitcoin spot ETF does get approved, are we going to see the likes of like Wisdom Tree, BlackRock, then be advising their clients to put, say, 1% of their portfolios into these Bitcoin spot ETFs? I'm wondering what you think this will look like if there is an approval in the near future.
I couldn't hear properly. Is it about the ETFs versus tokens?
No, I'm asking, so say a spot Bitcoin ETF does get approved, are we going to see the likes of BlackRock, Wisdom Tree advising their clients to put 1% of their portfolio, if you will, into these ETFs?
Ben, will you take this one?
You can find me later. I'm under very strict legal instructions not to discuss pending applications for spot Bitcoin ETFs in the United States.
Fair enough, thank you.
I can answer that real quick. I mean, you've already seen portfolio strategists actually give the nod to some crypto as being a portion of a well-balanced portfolio. That's not new. I mean, I can't remember the first time I saw it as part of a asset allocation schema. So I think it'll become more prominent. That's for certain.
Okay. Another questions? Oh, there is one.
How do you think this, the potential for tokenization could impact emerging markets? Because usually you see a lot of infrastructure in more developed markets, and sometimes the conversation is more about adoption, as you mentioned before. But when you go to emerging markets, or even frontier markets, the view could be different, but the infrastructure layer potentially remains the same. So how do you think it could play in the future, tokenization into the, let's say, deepening of these markets, or like how can it change the landscape?
Question about emerging markets, interesting one. Would you like to take this one, Gaetan?
Yeah, I mean, if I understood the question correctly, what would be the impact on the emerging market from an infrastructure standpoint? Yeah, I mean, I think one data point that I do have is, for example, as an infrastructure provider, a global infrastructure provider, we can deploy on all the continents, and the number of continents varies depending on where you've been born and raised. Some say there are 5 continents in the world, others say 7, but whatever. We can deploy anywhere except Antarctica. We have 70 points of presence. So location and distribution across different geographies is kind of the essence of how blockchain works and how infrastructure providers think about it. So I think the development around it is really nurturing the ecosystem that will use this ecosystem ultimately. And it takes a lot of cooks in the kitchen, I would say, in order to grow maybe underserved market or emerging markets. But I feel like the fact that the core technology is by essence distributed, and so as the head of protocol for Blockdaemon, I talk to 100+ different blockchains, including new ones, and a lot of their thinking when they start a blockchain is, how do I ensure that my base layer protocol will be decentralized, i.e. censorship resistant, and can survive any kind of catastrophic geographical event on whatever number of data centers where nodes are running at the base layer. So decentralization is at the core, and I feel like because of that parameter, emerging markets have a chance to just capture the value that blockchain can provide.
That's a very good point. And unfortunately, we are out of time. But I'm sure there are many more questions, and perhaps we can discuss them after our session. I would like to thank our experts, our panelists, for joining me, and thanks very much for your questions.